Good afternoon. My name is Jay Rosenzweig, and I'm in the business of helping organizations large and small design, build, and attract world-class teams. I'm also the author of the Rosenzweig Report on Women in Leadership, which I've been doing for the past 19 years and which we previously partnered with Female Quotient on. And I'm involved in a number of humanitarian impact causes, women's rights, and the environment being two key ones. So where do we stand with ESG? As we say, the ESG landscape is so rapidly evolving that it really begs the question, where do we currently stand with ESG? Are we witnessing a decline in ESG principles, or is there a shift in focus? I'm looking forward to this discussion, really, as we explore which sustainable development goals companies are embracing, prioritizing, and putting into practice to drive their mission statements and business goals. So we really have quite an esteemed panel today, who I feel honored to be moderating. And without further ado, I'll do a brief intro to each and every one of you. So Leah Ellis, founder of Sublime Systems and CEO. We have Karen Fang, Managing Director, Global Head, Sustainable Finance, Bank of Montreal. Bank of America. I was just at a Salesforce lunch with the CEO of Bank of Montreal. Bank of America. And we have Mary D. Wysocki, Chief Sustainable Officer of Cisco, and Lauren Smart, Chief Commercial Officer, S&P Global Sustainable One. So welcome all of you. And I thought I would start off by asking each of you to describe the scope of your roles and areas of focus and the emphasis of your organizations when it comes to ESG, and to go a step further even perhaps to really share with us what ESG means to each and every one of you. So I'll go left to right, and we'll start off with Leah.
Good afternoon, everyone. I feel so privileged to be here, especially with esteemed panelists. I lead a company called Sublime Systems. We are developing technology to address CO2 emissions from the cement industry. Cement, as you may know, is 8% of global CO2 emissions. If cement were a country, it would be the third largest emitter after China and the US, and that's because it's the biggest industry by mass in the world. Each ton of cement results in a ton of CO2 emissions. Presently, there is no technology to avoid these CO2 emissions without doubling or tripling the cost. So I am a chemist, I'm a scientist, I developed this technology at MIT. I've been commercializing it for 4 years. We have a pilot plant that's had thousands of hours of operations, and we're scaling up quickly. So sustainability means so much to me. I feel it's something that's not going to go away. It's captured the hearts and minds of so many people, but it really takes a village to bring this technology to market. You can't push a rope. So I'll pass it on to my panelists.
That's pretty fascinating, amazing. Karen?
So I'm Karen Fang. As the moderator said, I run sustainable finance at Bank of America, one of the largest financial service companies in the world. I have 2 jobs at Bank of America: to help B of A reach net zero across scope 1, 2, and 3 emissions before 2050, and deploy, as a part of that, $1.5 trillion in sustainable finance capital between 2021 and 2030. You will see how we have done in the first 3 years in just about 2 months in our annual report. What I'm allowed to tell you is that we have done more than $500 billion in the first 3 years ahead of pace. And that is a testament of companies, large and small. We have Cisco, we have Sublime. Really, the entire ecosystem, entire value chain is moving. Our customers are setting goals and decarbonizing because the end consumers are demanding it. And on top of science, right? When you think about this, it's not really a morality debate or even a science debate. It's a business imperative, and that's how we view it. Because ultimately, as a bank, our job is to really connect the supply and demand of capital. Everything costs money. All of my meetings at Davos, every single theme, every single goal, every single metric costs money to actually accomplish. So clearly, we need to get the finance going, get them to scale up. As a bank, our job is to scale up that finance, whether it's for climate transition, whether it's for social inclusive development, in line with the 17 SDGs, and that's precisely what we need to do.
That's excellent. We need more of that, Karen. And I always say, even when I'm advocating for women through my report, that if the moral imperative doesn't speak to business people, we always say that there's a business imperative, because study after study has shown that the more women at top levels of businesses, the greater the business results. So over to you, Lauren.
Great, thank you. It's wonderful to be here and to see so many familiar faces. It's a fantastic venue, this. So I'm Lauren Smart. I'm the Chief Commercial Officer for S&P Global Sustainable One. So S&P Global is one of the biggest financial services companies in the world. We have different bits of the business. We have a credit rating, biggest credit rating agency in the world. We have an index business, S&P Dow Jones Indices. We have a market intelligence business that provides financial data and insights and analytics. A commodities business, a commodities insights business that provides data on a whole range of energy industry information. And we also have a mobility business as well. So not many people know about all of those, but the key thing there is that each and every one of those businesses have information that is vital in terms of understanding transition, in terms of understanding sustainability and the global economy now and in the future. And so Sustainable One sits across all of those, and our job, it really is to provide the data, the insights, the analytics, tools to enable our clients across all the different sectors and segments in the world, insights to make their decisions incorporating sustainability information. And when we talk about ESG, what does that mean? So I'm quite deliberately using sustainability as a term. In fact, we had a women's breakfast earlier, and we were talking about just this topic. Sustainability, I think, is easier to understand and is more all-encompassing. It's become everyone better understands what you're talking about with sustainability. So ESG, whilst a lot of the lots of the data and the approaches are absolutely vital, sustainability feels like a broader term.
Sounds great. Mary?
So for those of you who aren't familiar with Cisco, Cisco basically securely connects everything to enable anything. And my job is to make sure we do it in a sustainable way. So when you think about that, how are we helping to enable the acceleration or adoption of renewable energy? That triggers our own decarbonization goal, net zero across value chain by 2040, as you mentioned. Our own history, we've been reporting out on our journey since 2005. So we've got a lot of history and learnings that we can share with our customers. And we think our products and partners can really help enable this kind of green and digital transition. But we're also looking at how we design our products to be the most circular, to really design out waste, really think about how you can use products in the field longer, using more modular capability. But also, I think we've all lived through the last couple of years where business continuity, we now are so dependent on the communities, the ecosystems, the communities that we operate. So how do we invest in resilient ecosystems, really helping communities really adapt? So when I think about ESG, having been reporting, I see it as a framework. How can we create some common standards so we can talk about our strategies, our initiatives, and our progress?
Sounds great. Well, I have some open-ended questions for each of you, and you could choose to grab it as you wish. What are the compelling reasons that indicate ESG metrics and investing are not just a passing trend, but a fundamental shift in the business paradigm? I'll leave it open to you.
I'll take the first pass. We'd love to see if you agree. I really see increasing regulatory pressure, which is really looking for credible, reliable data. And more companies, that's where we're trying to figure out how do we communicate our strategy, our initiative. But we're also hearing it from our customers, our investors, analysts, advocacy groups. So that, to me, our new hires are looking for what we're doing in this space.
I would say that, really is the word framework, right? And I remember, I've been with Bank of America for 14 years. I remember 4 years ago, our CEO said, we're going to have you lead this work. What do you want to call it? ESG investing, sustainable investing, impact investing, all the words came up, and a lot of it just around ESG. And at the time, not that I had the foresight necessarily, I said, well, everything we do is about financing investments. We should really just make sure those are sustainable.
Right.
Let's call it sustainable finance.
As an aside, what was your previous role when you were tapped?
I ran cross-asset trading in global markets and ran structuring and solutions. Obviously, structured finance is my background.
Yeah.
So when you think about that 4 years ago, obviously today, this, depending on who you ask, it takes a different meaning, right? So I think when we make it complicated and abstract, it really kind of leaves a lot of room for guesstimates, speculation, interpretation. It really is just about our business models, right? In our value chain and supply chain has to be more sustainable. We have to lower carbon. We have to make sure we do this in an equitable, just way. We can't leave those behind that we have that are underserved and underprivileged, basically underserved and underprivileged. So we have to make sure we do that sustainably and for societal purposes, also for environmental purposes. So I think really is just ingrained in the corporate DNA, ingrained in the consumer DNA. We all want, to have a, frankly, more sustainable society. So the last thing I'll tell you is an anecdote. When New York City, where I live, had the wildfire, right, where our orange, our sky turned orange. For those 2 weeks, I had the least amount of debate around ESG. Everyone wanted to know what they can do to help with the environment.
Quickly, right?
I think some of them actually have been converted.
Good. That's great.
I may talk about a trend. So we spoke about the regulatory pressure. We're also talking about the money that's flowing into sustainability, which is super encouraging. I want to pull up another thing, which is talent. I lead a startup that's spun out of MIT. We're situated 15 minutes between Harvard and MIT, and I'm seeing so many young people. And they don't care about how much money they make. They want to do something that they care about, and they want to work hard. And they want to work hard on something that they care a lot about. If they're going to burn themselves out, they're going to burn themselves out for a cause. So I find myself hiring people who are taking $100,000 pay cuts to come and work on something that they can build their own legacy, and they can wake up in the morning and be excited to come to work and have no climate guilt. And I feel very privileged to work with people who, when you work on a mission, you get smarter people who work harder for less money, and they also work better together. Because when you lead a mission-driven organization, there's no fame and glory in one person. You understand that you have to work as a team to accomplish your objectives, and that's really cool.
That's awesome. Well, as someone who runs a talent firm and as someone who's optimistic about our world, I always say my optimism is rooted in the youth. So it's really wonderful to hear. And I believe if you're mission aligned, the money will follow as well, because there's upside to these businesses.
Yes,
what say you, Lauren?
I would totally agree with everything that's been said so far. I mean, without a doubt, coming from, I was started a startup called Truecost many years ago, and so that we were totally united by mission. We've taken that mission when we sold ourselves to S&P, that we took that mission into S&P, into Sustainable One. When we've been buying businesses, that's been really important as well. That shared mission, suddenly you integrate so much better. So I totally agree. Regulation. I mean, yes, it's without a doubt, regulation is making it an absolute imperative to be able to incorporate sustainability data, in particular climate-related data. We have the CSRD in Europe now that affects huge numbers of companies. So transition and how you're going to transition, the quality of your transition pathways is absolutely vital. And then to Karen's point, we all want sustainable long-term cash flows. That's what sustainability is about. We're looking at as well is around making sure we have robust business models that meet the needs of today and the future. So I think it's all of those three.
It's interesting. Most of our new hires, before they even decide to interview with us, they read our purpose report to decide if that's the place they want to work.
That's amazing.
And same thing, one of the challenges, I think, as we think about our customers, one of the key things is helping them understand how do they discern information. So I still think this is one of the reasons that we need to be able to have frameworks we align to, the ability to have that transparent, verifiable data, so that they know when they're purchasing something or using a service or partnering with an organization, not only may it align with their values, but it's also, especially when you think about carbon accounting, the interdependency, we all have got to move together.
And I may just add one thing. I think regulation is always seen as an inhibitor. I do think regulation can be an accelerator if it's done right. And you think about a lot of the voluntary carbon reportings, all of us report on TCFD, TNFD had just come in, gathered 300 companies. A lot of these voluntary reporting is good, but the standards then are subject to, interpretation. So a lot of this is if truly public sector driven regulation can take the input of a lot of the voluntary regulation that we put on ourselves and make them easier around disclosure, around measurement, and all of a sudden we actually have a much faster momentum towards, really homogenizing, right, all the disclosure so we can compare and contrast, and then we can actually say who's making progress, who's on the right pathway, who's not, and all of a sudden we can actually make sure we address the issues. So that is one thing, and a lot of the regulation, correct me if I'm wrong, is around disclosure and climate risk. We need a lot more of that for each individual sector, decarbonization. So we need the regulation to become much more technical as well. So when you look at aviation, CORSIA is looking at SAF, shipping, Poseidon Principles is looking at green methanol, for example, green ammonia. We have to make sure these things are not just a voluntary mandate as well. We have actually make sure that is actually put in place on the technical level, cement and steel. So we have to do that because that will drive demand signal, which then will subsequently drive supply. So that may be kind of one step further than what you wanted.
Sure. No, but it makes a lot of sense.
Regulation on a much more concrete and technical level as well.
Well, right, can I just build off that?
Yeah,
I totally agree.
Absolutely.
I heard the phrase.
Taken over.
Yeah, wait. I heard the phrase. There was a question. I was on a panel, and the question was, is it the responsibility of the policymakers or of the companies to be, doing the reporting? And I think the answer we came to as a panel is it's a dance. It has to be this kind of tango between the two, because you need to make sure that the policies are sensible, practical, that they're adopted, and then and equally you can create those drivers, which means that you can. Best practice can be spread more widely. So as I've been thinking about this, I think this tango, this dance between, is where you get the really good quality reporting.
To follow up on that dance metaphor, we also need to take a break from the dance because the amount of time it is now taking most private sector companies' teams to actually do the reporting, it is a lot. And part of that then pulls us a bit away from all of our other kind of actually delivering the impact we're looking for.
Peak pledge. Somebody said to me the other day, we have reached peak pledge, and we need to execute on progress. Progress versus pledge.
As we tango.
So to the point about reporting and measurement, why don't we hone in on that a little bit more so that the audience can be clear on how are ESG initiatives currently being measured? And what are some of the challenges with these measurements and these methods of measuring?
I can, again, take a stab and love your insights as well. As I mentioned, we started reporting in 2005, but it was just last year that we really established a much more rigorous data foundation across the company, anticipating voluntary disclosure is going to be financial. So really putting in the same kind of financial rigor, the ability to have a taxonomy, controls, auditability. We align to all the different frameworks that we find are relevant and robust, such as GRI, SDGs, TCFD. We also report out on CDP, which is a great tool for all of us to understand our progress against the journey. So to me, I do think one of the things, I've seen some great reports, I've seen some great dashboards, but if the underlying data isn't relevant, isn't verifiable, isn't defendable, and ultimately we can digitize that allows us the insights. That's been an area we've really focused on this last year.
I would say the best thing I've heard in this Davos is actually AI's application to using really kind of gathering all the data, aggregating it, and making reporting according to all the standards. I mean, I think you just heard a bunch of them. There's a lot more, and obviously the regulation that's coming down, a lot of those are voluntary. So SEC, right, the SEC, ESG disclosure rules obviously are pending, but supposed to pass. We'll see what that looks like. In Europe, you have the Sustainable Finance Taxonomy. You have clearly CSRD, right? So for both E and the S. So we have a lot of the regulation that's actually coming, and that's leveraging, I would say, the private sector voluntary reporting mechanisms. Too many, right? So if this is where you are in the AI sector, please come in, because I think it's a huge business opportunity for you all, because all the consultants and all the reporting companies need it. We need that data to be machine learned and to actually really deliver that disclosure at the standards and the speed that we need, right? So AI's application is many in climate transition. We can probably spend an hour on that and permitting and all the other stuff. But in accounting, measurement, disclosure, reporting, for sure, huge business opportunity.
Leah?
Yeah, I think a lot about carbon credits and the different types of technologies and things that generate carbon credits. And we know there's a lot of skepticism about voluntary carbon markets and the quality of what you're buying. I'm participating in the World Economic Forum as a tech pioneer, and I wrote a blog post about the three ways that you can address the climate crisis and the CO2 emissions. One is avoidance, the other one is point source carbon capture, and the other one is direct air carbon capture. And all of these things have different value in the eyes of regulators and in the eyes of the voluntary carbon markets, and sometimes these incentives are backwards. For example, direct air carbon capture, a very inefficient technology that if you invest too heavily in that, you get into a do loop where you've never put in the hard work to actually avoid emissions and get into a post-carbon world. But it's very difficult to measure carbon avoidance, especially when it comes to nature-based solutions. And that's why I think you really need technology-enabled carbon avoidance in cement, steel, ammonia, so that you can tie the carbon avoidance to the commodity product and have that traced through the value chain.
Lauren, any thoughts?
So taking an investment angle, I think when it comes to reporting and sort of some of the trends there, I think one of the challenges with these sort of like ESG terminology is that people thought, for example, they were buying an investment fund that had ESG on it and that they would all be the same and they'd all be doing the same thing. For example, why has my ESG fund got traditional fossil fuel companies in it? And obviously, those who are practitioners will say, well, there's all sorts of different approaches. You can have a best-in-class approach. You could have a screened approach. You might have one that's aimed at clean technologies. You might have, an index-based approach with a low tracking error, and that's got a little bit of everything in it. But they're the best-in-class companies, and none of those are wrong. It's just different approaches that fit different parts of an investment portfolio. So what I'm going to hear is that some of the regulation is around transparency and clarity. And I think that we touched on earlier about like naming and the importance of the terminology that we use to describe what exactly it is that you're buying in an investment portfolio, what it's delivering. And that will look different for all sorts of different clients. And for one client, even if it's one asset owner, they're going to have all sorts of different places in their portfolio with different risk appetites, for different asset classes, for different approaches. So I think it's that kind of like that clarity and transparency of what a particular fund is seeking to achieve. And some of the regulation, I think, is very helpful in providing that clarity, and also it helps to avoid some of kind of greenwashing claims or to undermine confidence in ESG funds by being just cutting through some of the terminology and making it crystal clear what it is and isn't trying to deliver.
Fantastic. So my last question, and we only have a little bit of time, so it relates to the intersection of social change and environment. So if each of you might be able to sort of briefly, even though this could be a session in and of itself, how the two drive one another, because they're often found under one umbrella in the corporate world at least.
That's partly why when I mentioned investing in resilient ecosystems,
right.
It's so interdependent.
Right.
The people who are most impacted by climate, the people that are the most vulnerable population. So it's not only, we talked a little bit about that kind of green transition. Are we helping communities adapt to new climate reality? Are we building the skills for this new economy? Are we using technology to restore biodiversity and ecosystems? So you can't do one without the other.
Right.
Yeah, I mean, the just transition, I think, is absolutely vital. We've been talking a lot at Davos about nature-based solutions, integrating nature risk, and also some of the difficult challenges we've got. So we've done some analysis on nature and energy transition-related materials. We know that we need a lot more lithium, copper, cobalt, absolutely critical materials for energy transition. But there are many of those mine sites are in key biodiversity areas. So, for example, in Mexico, many of the there's 42 copper mines in Mexico that are in key biodiversity areas. I was in Argentina recently where a lot of the lithium mines are, and I saw protests from indigenous communities because the way in which those lithium mines are being operated pollutes the water. The protest was about the destruction of their liquid gold, water obviously being critical there. So I think what's vital as we're thinking through energy transition is thinking through nature positive and just transition and making sure that all of the pieces, a holistic approach is being taken.
Right. Great. Well, we're out of time, but I'd love a few final words from the two of you, from both Mary and Leah.
I think climate equity or environmental justice, right, are absolutely essential. Because ultimately, without the global south transitioning, without all the underserved communities joining in the climate transition, we're not going to reach net zero. So when you look at the United States, when we think about the incentives, we don't have a lot of time to drill into all the different pieces of movement. But you look at Inflation Reduction Act, that's obviously powering $300+ billion of incentives into clean transition. A very important connective tissue to that was the Justice 40 initiative, which means 40% of the incentive should be invested in underserved communities. And we have energy community. They give additional incentives if you're building a wind and solar and low carbon cement plant, for example, in the underserved low and moderate income areas, as well as energy communities that used to be powered on coal and what have you, and the jobs are gone. So a lot of this is about jobs. A lot about this is about economic empowerment of communities. Without the people, there's no really power to drive towards, net zero. So a lot of this is that. And the other intersection, which we talked a lot at this Davos about, is really the climate and health. The reason I use the wildfire example is no one wants dirty air. No one wants dirty water. No one wants to have malaria or cholera, waterborne disease when you have flooding. And no one wants extreme heat and dehydration. So those are the things that really kind of make climate change more visible. It humanizes it and really makes all of us feel to our core. And those are the things that get the young recruits to join this fight, get all of us to commit to this from a corporate perspective, get the government to really try to do the Justice 40 type of thing to really drive a lot of momentum into the movement.
Yeah, thank you. So 30 seconds or less,
Briefly,
Leah.
I will say it's interesting that much of the clean tech funding in the Inflation Reduction Act is going to red states. And it's also very interesting that old manufacturing towns, which have been left behind and suffer from, the people suffer, the environment suffers, the architecture, the rail lines, the power lines, those make it interesting for clean tech to now go there. And that's where loads of this money is coming. And it really brings poetic justice.
Thank you. A big round of applause for these amazing ESG experts and humans. Thank you. Thank you all.